Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 11th of June 2019 and we're reporting on the recent weakness of the US dollar. Is it about to collapse or just weaken further? Let's investigate. We are all aware that 2019 saw an about change in Fed policy on interest rates. When it raised rates on December 2018 by 0.25% to a federal funds rate of 2.25 to 2.50, this had a significant effect on stock markets and frequent calls by industry and President Trump for lower rates, not to mention data impacts, caused the Fed chairman to issue a number of dovish statements, thereafter almost guaranteeing that there would be no more interest rate hikes in 2019 and that the next move would likely be downwards. We then witnessed some positive labour figures, many of which were downgraded last week, in fact by 75,000 jobs combined for March and April, with a non-farm payroll report last Friday showing only 75,000 new jobs being created in the month of May, against an expectation of 180,000. That helped push the 2019 average down to just 164,000 jobs, well below the 223,000 average seen throughout 2018. The data was seen as validating market bets, suggesting the Fed will cut its interest rate on multiple occasions before the year is out. Lee Hardman at MUFG, Mitsubishi UFJ Financial Group, stated, quote, "The 75,000 gain in NFP in data for May released on Friday was far weaker than expected, especially incorporating the 75,000 downward revision to previous months. All downturns start with a decelerating in the pace of job creation, and hence another few months of employment slowdown would be persuasive evidence for the Fed to take action." Unquote. This immediately led to a devaluation of the US dollar as markets factored in an interest rate cut, possibly by July. In fact, Reuters report today, quote, that the dollar is hovering just above a recent 2.5-month low, as bets on an interest rate cut by the Federal Reserve increased, although investors were wary of selling aggressively before a Group of 20 summit this month. Markets are only pricing in about a 20% chance of a rate cut in June, but they are pricing in about a 100% chance of a cut by July. A policy meeting is due next week, unquote. Now, against a basket of currencies, the dollar stands at 96.76. That's the dollar index, near a late March low of 96.46. It has fallen 1% so far this month. But is this a sign of a collapse in the US dollar? Well, what we do know for certain is that markets are looking for signs at the upcoming G20 meeting at Osaka, Japan on the 28th to the 29th to give a steer. Of course, markets are concerned about the increasing trade tensions with China, though are pleased about the arrangement made with Mexico. Attentions will be directed towards President Trump and President Xi's interaction, and whilst few expect a deal before then, some are hoping for a surprise announcement. Policymakers, economists, and to some extent most traders have for some time taken the view that the positive effect of the White House's 2018 tax cuts would eventually wear off, leading to an automatic slowdown in the economy. But surveys have recently pointed to a sharp loss of momentum in the manufacturing sector, which have led some to fear that President Donald Trump's trade war with China is now beginning to hurt the domestic economy too. From a banking perspective, and let's not underestimate its importance, even though it may not have a particularly popular image, capital flows tend to move in the direction of the most advantageous or improving returns, with the threat of lower rates normally seeing investors driven out of and deterred away from a currency, while rising rates have the opposite effect. So this suggests that there could indeed be a run on the dollar. Not so fast, we say. The Fed is very much aware of this, and the recent weakening of the dollar, ironically, may provide the Fed with the ammunition it needs not to lower rates. Well, not immediately. If the dollar is already falling, why lower it further and cause these major capital outflows by doing so? We are not yet sold on a rate cut in June or even in July, but September may be a different matter. Another prospect to bear in mind is that other currencies are not faring much better either. Our recent YouTube videos, some of which we have highlighted in the description below, have pointed out that China is looking to cut rates or ease economic policy by allowing the yuan to fall. The UK has a weakening sterling due to the uncertainty concerning Brexit, and the euro, whilst up against sterling, has performed well recently in comparison, but has its own problems, with some of its member states moving towards a severe recession and the European Central Bank looking at quantitative easing measures to help them. So, we have sterling and the euro in potential or real difficulty, and these are two of the 6 currencies which make up the basket that comprises the US dollar index against which the US dollar is compared, the other 4 being the Japanese yen, the Canadian dollar, the Swedish krona and Swiss franc, and one would hardly state that they are performing in stellar fashion either. Plus, the SDR, or special drawing rights, which comprises of 5 currencies, namely the US dollar, the euro, the Chinese renminbi, the Japanese yen and the British pound sterling, have 4 of its components with weakening values, and again, the yen is not a stellar performer either. So the US dollar is not in that bad a shape as many pundits attempt to make out. And so much will actually depend upon who breaks ranks first and lowers rates. There is no doubt that the trade tariffs with China are hurting the global economy, although some will argue that it will hurt China less than the US, as China now has a greater disposition towards a domestic consumption growth agenda as opposed to an export one. And our video published yesterday pointed this out. Regardless, though, of who is affected most, there is no doubt that global rates are more likely to fall than rise. And the key question is, which economy has to devalue the greatest to gain competitive advantage? We are just simply not that confident at this stage that it has to be the United States. But let's just wait and see. What do you think? We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.